Dieter Scherer here from RealizeYourRetirement.com. Today we're going to cover the question, how does inflation impact my retirement income? Protecting a stream of income from the impact of inflation during retirement is an important and often overlooked piece of retirement planning. You see, many retirees focus on preserving capital without considering the value of a dollar through time. So in this video, I'm going to cover what inflation is, how it's measured, and the results of a study I've done that measures the impact of inflation over the past 100 years. So what is inflation? Well, inflation is a general increase in the price of goods and services within the economy. I'm going to use an example in this case of bread. Say bread is selling today for $1 a loaf. Well, say we have 5% inflation this year. That means that the price of bread next year is going to be 5% higher. So the new price a year from now is $1.05. The dollar you now have today is worth less a year from now. It's actually only worth around 95.2 cents if we're going to compare $1.05 next year to today's dollars, meaning you only have 95% of the purchasing power that you did in the prior year. Over time, this really impacts the ability to maintain your lifestyle, so inflation is very important to take note of. So how do we measure inflation? As we covered a moment ago, it's an increase in the general price level of goods and services within the broad economy. So bread increases 5%, most core services are going to increase around 5%. And that's measured via the Consumer Price Index, also known as the CPI. And the CPI measures all of the core goods and services that the average American household buys each year. If those goods and services increase in price year over year, we determine that there is inflation within that year. So if the CPI increases from 100 to 105, there's 5% inflation that year. So here I have part of the study that I did on inflation and how it impacts the value of $100,000 through time. Now we have about 100 years worth of data here. The data starts in 1914 and ends at the end of last year. And what we're looking at here is the value of $100,000 in 10 years, in 20 years, and in 30 years in three different scenarios. One is a high inflation environment. Another is a median inflation or average inflation. And another is low inflation or deflation. As you can see, in the deflationary environment, in 10 years, $100,000 is actually worth $119,000. And that's because deflation means negative inflation, meaning that the bread, instead of going from $1 to $1.05, would actually have decreased in price to 95 cents. And that can have some problems for the economy, so it doesn't work that well for the economy. So in most scenarios, in just the average scenarios, if we look there, in 10 years, we only have about 75% of our purchasing power. In 20 years, we have about 54%, and in 30 years, we have 36%, meaning a value of $100,000 after 30 years is going to drop by $64,000 in terms of purchasing power today. So you need a lot more money to maintain your lifestyle if it is constant in $100,000 today. So a static income stream that is only $100,000 would only give you $36,000 worth of purchasing power after 30 years in the average scenario. As you can see, in a high inflation scenario, it's only worth $21,000 a year. So what are the historic rates of inflation? Well, median inflation over a 30-year time period has averaged about now 3.62%. Low inflationary environments, about 1.5%, and high inflation, about 5.13. So that can drastically differ the amount of dollars you have at the end of the period. As you can see, it's $21,000 versus $36,000. And in low inflation, it's $62,000. So the amount of inflation within the overall economy is really going to impact your ability to maintain your lifestyle if you only have static or income streams that barely keep up with inflation. And here I have converted those dollar amounts into easy to use percentages. So if you want to calculate what the value of an income stream is, say you want $200,000 a year in income, well, just multiply 200,000 by 75%, and in an average scenario, you'll have about $150,000 worth of purchasing power after 10 years. After 20 years, you'll have 108,000, and after 30 years, you'll have 72,000. This can be done with any of these, but I've just converted the values that we saw in the first slide to percentages so that we can easily calculate how much we might have from an income stream in high, median, and low inflationary environments in 10 and 20 and 30-year periods. So what types of investments are hardest hit by inflation? Well, it's generally retirement income that does not increase through time via participation in the stock market without high fees, or it's some sort of static income stream. So annuities that don't have an inflation protecting feature on it, pensions that just offer a straight life annuity without any inflation adjustments, and then bonds, which pay a straight percent of their face value. And if you don't reinvest those and try to get more returns by reinvesting them in other bonds, then you're just going to get the same amount of income over time, and it's not going to really keep up with inflation. So any income loses purchasing power if there's not a cost of living or inflation adjustment, or you don't reinvest those dollars within another bond or another stock. And fixed index and variable annuity income riders may not keep up with inflation. If you've watched some of my other videos, especially the ones on annuities, you may see that in a lot of cases, even in best case scenarios, because of the fees and the manner in which the withdrawals are taken from the annuities, income riders may not keep up with inflation just because of how they're structured. And insurance companies, just with such a low interest rate environment, because they invest in bonds for a lot of these guarantees, they can't guarantee very high interest rates. So it will be difficult, even with participation in the stock market, because of the high fees on things like variable annuities, to really keep up an income stream with inflation. So if you have any questions, feel free to contact me via the Contact Me menu option at the top of my blog. Just fill out your email and whatever your question is, and I'll get back to you within a couple business days. And if you'd like more content, please subscribe to email updates and exclusive subscriber content by entering your email at the bottom of the post or on the sidebar. Thanks a lot for watching, and I hope to see you in my next videos. Hello everyone. Today I'm going to do a review of the Jackson National Perspective 2 annuity with the Lifeguard Freedom Flex Income Rider. For those that don't know me, my name is Dieter Scherer. I'm an independent, fee-only financial planner. That means that I don't receive commissions for financial products, nor do I sell annuities.